Welcome to the Kendall Report, where I share my 40 years plus of experience. I help you to manage and protect your assets. If you like what you see in these videos, make sure you like, favorite, and subscribe so others like you can find this content. The market rally continued today with the S&P finishing up 6.2%. Everything was based upon the passing of the stimulus bill, $2 trillion that our wonderful senators found a way to get themselves a raise of $37,400 a year. Somehow that seemed appropriate. It just couldn't be about the American people and the crisis. This in itself tells me that the crisis may not be everything that many think it is. The numbers still don't add up. Here in Arizona, our governor shut down all the restaurants and all kinds of businesses. We have 150 sick people in this state, and 2 have died. So for that, you shut down the entire state, all the commerce, and they're doing the same model across the country. The consequences from this shutdown cannot be measured yet. There are going to be industries that one industry tips, causing another one, the supply chain all the way down is going to be affected. The scenario is, what if we are shut down for 60 days or even 90 days? What does America look like if you shut off major cash flows for 90 days? How many things break? What companies go out of business? And what are the implications going even further? If we went 6 months on this craziness, there would be 30+% unemployment. There would be numbers that we've never seen going back to the Great Depression. Well, I certainly hope that's not what happens. In this world we live in, we've already seen, in my opinion, a massive overreaction to what's going on. And now anything is possible, especially in this socially driven world we live in. But as we look into the markets and what happened today, we've moved 20% off the low, so that sounds pretty good. But 20% off the low still means we are 20% down from the highs. So we're a long ways from being out of the woods. And I talked about the stability that I saw 3 days ago. It's moved into a pretty decent rally, but now we're at the point where we're going to hit a wall. If everything else is based on the Fed's alphabet soup of A through Z and every possible quantitative element they could come up with, markets are going to have to digest. So they have to figure out how much the stimulus actually does. What are the impacts, which we don't know yet. We won't know for at least 3 to 6 months what the true impacts of shutting this down for 4 weeks or longer. My biggest fear is that we shut down for 60 days and everything really starts to come off the rails. The airline industry is virtually not flying any flights at all. So we're seeing that industry shut down. One of the events that happened today, I thought it was interesting, that nobody picked up on, was crude oil made a new low. Remember 5 weeks ago, that was the reason why the markets crumbled and we had the big gap lower on March the 2nd? Well, it made a new low today and everybody seemed not to care because of the stimulus and the alphabet soup. But the crude oil is actually telling the story of the global decline that is happening. This is something we still have to pay attention to. I've mentioned it many times over the past several days, but these unintended consequences are going to be huge. Believe that this moment, more or less, a Bear Stearns moment, because what we're seeing here is there's some stability. It looks like we patched a bunch of holes. The aggressive stimulus and both fiscal and by the Fed, but I think we're going to have some real hell to pay 2 months, 3 months down the road. Let's go through the technicals, because I think there's some real nuggets that we can look at to bring in some perspective of what's likely to happen over the next week and maybe as much as 3 weeks. I always remember this comic when I started in the markets back in the early 80s. A friend of mine had this on his wall, and I was able to find it on the internet. So you don't want to be this guy. That's why I continue to suggest that you exercise a lot of caution in these markets. Everything in this market is changing very quickly, including the momentum. If you'll notice, the ppm 1, 2, and 3 have moved sharply higher, suggesting that there is a 60% probability for a low for the next 8 to 12 sessions. The move toward the 21-period moving average, however, suggests that we are likely to see a retracement. I'm going to draw in exactly what I think is going to happen in this pattern as we unfold over the next 5 to 8 sessions. The pattern that we are seeing unfold should unfold in a 3-3-5 pattern, meaning 3 days up, 3 days down, followed by a 5-day upward sequence. This next few days should be on the downside, and overnight we're experiencing some weakness, down about 2% right now, but this pattern is likely to unfold with this type of configuration. We do have a gap that is at this level, so we should come down, fill this gap, and then rally back up. We may get a very complex pattern because these moving averages are all going to start coming into play. They're going to come into this pattern. They're going to represent the resistance points and the configuration that's likely to unfold. I mentioned in last night's broadcast, there is still some vulnerability for this market to fail completely and not stop at this right shoulder and just continue down. Based on what we're seeing from the momentum indicators, there's only a 20% probability for the market to decline like I just showed you. The S&P should unfold in this pattern. We have one leg completed, get a leg down, fill the gap, set up, moving averages will come in. We could see a very complex pattern with the probabilities of getting up between 2750 and around 2820, but we're talking from this pattern as long as 4 to 6 weeks. Intermediate charts are showing that we made a new low this week, a higher high, and we're back to the 200-week moving average, which is currently at 2630. Last evening, I talked about a target between 2580 and 2620. We exceeded that, and now we've got numbers right at that 200-week moving average. This is going to be a key point, and with the weekly momentum as negative as it is, it suggests that we are likely to see a continuation of the pattern. If we close above the 2524 level today, we should see a continuation of the pattern. Let me show you exactly how this should. It's likely that we will set up as a wedge pattern that will trade in this range for the next several weeks. I still believe the next leg is down, but this pattern could extend depending on how the PPMs down below here come into play. Right now, all 3 PPMs are in extreme downward trends, suggesting that ultimately the 10-week moving average will become the major resistance point, but that's several weeks in advance and could be as high as these numbers I just mentioned. Between 2785, 2820 would be the extremes of that pattern. Since I mentioned the crude oil earlier, let's take a look at this daily chart. You can see the 10-period moving average is down sharply. Yesterday, crude went down to 19.46, so $19.46, closed a little bit above the lows. Was not a new low close, but definitely rendered a new low. And you can see all 3 of the PPMs are continuing to be under extreme pressure, suggesting there is possibly another leg lower. Could see as low as 1750. And if that happens, then that will certainly raise some eyebrows, and market participants in the equities will have to reconsider what they're thinking about the world economic situation. This will complete the broadcast. There will be a more in-depth analysis on Sunday night's video. Have a great day and a great weekend. Talk to you on Sunday night.